I've been observing something for a while now. For the past few months, really for the last couple of years, it's become inescapable. Turn on the TV, open a paper, scroll through your feed, it's everywhere. Gold. You can't avoid it. They tell you gold is at a record high. They call it the ultimate safe haven. With inflation running hot and the world feeling uncertain, voices are shouting that you must own some. They present it as the only way to protect what you have, to safeguard your family's future. They're calling it the one sure thing in a world that feels anything but sure. And you know what? A lot of folks are listening. Billions of dollars are flowing in. When people get scared, they look for an anchor. And that's precisely where we find ourselves today. But I'm here to tell you something important. The conversation everyone is having about gold, it's the wrong conversation. It's completely upside down. Most people believe the story of gold in the coming years will be about whether the price ticks up or down. They think it's all about charts and inflation hedges. But the real event, the seismic shift that's coming, well, it has almost nothing to do with the price. What's approaching is something far more fundamental, far more powerful, and it's a story that almost no one is watching. Before we're done here, I promise I'll show you exactly what that event is. More importantly, I'll explain what it means for your savings and what you should consider doing about it right now. This is a reality that's been sitting in plain sight for decades. But before we get to that, I need to share something else that's been on my mind, something that frankly keeps me up at night. You see, every generation believes their market is unique. In every era, people utter those three famous words, "This time is different." But here's the uncomfortable truth. What I'm seeing today, I haven't seen anything quite like it since 2008. Now, it's not identical, it's not, but it rhymes. And that rhyme, that quiet similarity hiding beneath all the noise, that's what gives me pause. Because when you start hearing echoes of 2008 in a market everyone insists is stronger than ever, that's when experience tells you to stop, take a deep breath, and look carefully at what's around you. People often ask me, "Warren, should I sell everything? Is a crash coming?" And I always give them the same answer. Don't ask me when. Ask me emphatic why. Because when you understand the emphatic why, the emphatic when tends to take care of itself. Stay with me, because by the end of our talk, I'm going to show you what that why looks like today, and it's probably not what you're thinking. The gold story nobody is telling. Let's start at the very beginning. People have been captivated by this yellow metal for thousands of years. It's in our oldest stories, our history books. Kings and queens piled it up, and for a long time it served a real purpose as money. It was durable, portable, divisible. It worked. But we have to be perfectly honest with ourselves about what gold fundamentally is as an investment today. This is the first piece of the puzzle you must grasp. Let me offer you a little thought experiment. Imagine we took every ounce of gold in the entire world, everything ever mined, all the jewelry, all the bars in Fort Knox and every other vault, every single coin. If you melted it all down, you'd have a cube that's about 68 feet on each side. Think about that for a moment. A 68 by 68 by 68 foot cube. It would fit comfortably inside a baseball infield. You could walk around it in under a minute. Now, at today's prices, let's call it roughly $2,000 an ounce, that little cube would be worth somewhere in the neighborhood of $13 to $14 trillion. That is a staggering sum of money. There's no doubt about it. But here's where it gets truly interesting. With that $14 trillion, what could you actually do? Well, for starters, you could buy every single acre of farmland in the United States. You could also buy about 16 Exxon Mobils, some of the most profitable enterprises on the planet. And after buying all of that, you'd still have about $1 trillion left over for, let's say, walking around money. So picture this clearly in your mind. You have two choices. Pile A, that's the cube of gold. Or Pile B, that's all the farmland in America, plus 16 massive cash-gushing corporations, plus $1 trillion in cash. Now let's do something revealing. Let's fast forward 100 years and see what we have. The cube of gold. It will be exactly the same. Still sitting there, 68 feet on each side. Maybe a tiny bit bigger if they've mined more, but your original cube is unchanged. It will have produced nothing. It will have earned nothing. It will just sit. You can polish it, you can admire it, you can stare at it, but its value a century from now will depend entirely on one thing: what someone else is willing to pay you for it. Now, let's look at Pile B. Over those same 100 years, all that farmland will have produced incredible amounts of corn, wheat, and soybeans. It will have fed millions of people, generating trillions in revenue, year after year after year. And those 16 Exxon Mobils, they will have produced enormous amounts of energy, employed millions of people, and most importantly for you, the owner, they will have paid out trillions in dividends, and they will likely be worth many, many times what you paid for them. You see, Pile A produces nothing. It just sits. Pile B, that's a cornucopia of prosperity, a relentless engine of wealth creation. And this single comparison, this is the bedrock of everything I'll share with you today. The distinction between a non-productive asset and a productive one is the most important concept in all of investing. So why does fear drive people to gold? So why do people get so excited about the cube? Why are they so desperate to own a piece of it? One word: fear. Gold is the ultimate fear asset. When people lose faith in everything else, their government, their currency, the future, they run to gold. It feels ancient. It feels permanent. And commentators and salespeople play on that fear masterfully. They show you charts of government debt soaring. They tell you your dollars are becoming worthless, and they present gold as the only lifeboat. But let me ask you something. Have you felt that pull? That little voice in the back of your head whispering, maybe they're right. Maybe I should have some, just in case. It's a very human instinct. I understand it completely. The problem is that instinct, that decision made from fear, often leads people to a terrible long-term financial choice. You're choosing to sterilize your capital. You're taking your wealth and putting it into something that cannot, by its very nature, grow or produce anything. Let me tell you a story. Back in the early 1980s, inflation was raging. The world seemed to be coming apart. People piled into gold. It hit a high of around $850 an ounce in 1980. The fear was palpable. But what happened next? For the next 2 decades, gold did nothing. It went down. It languished. An investor who bought at the peak in 1980 had to wait nearly 28 years just to get back to even, not even accounting for inflation. Their purchasing power was decimated. Meanwhile, during those very same decades, the stock market was climbing, businesses were expanding, dividends were being paid. 2 paths, both starting from the same point of fear. One led to stagnation, the other led to tremendous wealth. The only difference? The choice between a sterile asset and a productive one. My first lesson in the market came when I was 17 years old. I bought my first stock, City Service Preferred, 3 shares at $38 each. Well, it went down to $27, and I panicked. When it climbed back to $40, I sold. I made a small profit and felt brilliant. Weeks later, it shot up to $200. That was my first real lesson. The market punishes impatience and rewards endurance. And yet, today's investors, even professionals, have forgotten that. They're trading the news, the noise, the headlines. They're treating the market like a casino with better lighting. But here's the thing. The system now encourages that behavior. We've built a world where algorithms, not investors, control the flow. Stocks don't always rise because of fundamentals anymore. Sometimes they rise because someone programmed a computer to chase momentum. And I'll tell you right now, momentum has a shelf life. How we got here. Before I explain what reminds me of 2008, you need to understand how we got here. Because if you don't understand the foundation, the warning won't make sense. After 2008, the Federal Reserve did something unprecedented. It took interest rates to 0. It printed money, a great deal of it. And everyone said, that's fine because inflation is low. And it worked for a while. Markets recovered. Housing came back. Unemployment fell. But something else happened that very few people noticed. Debt exploded. Corporate debt, government debt, consumer debt, all of it went straight up. We became addicted to cheap money. Now, think about this. For 15 years, investors were trained to believe that money would always be free, that borrowing was safe, that if anything broke, the Fed would fix it overnight. But what happens when the medicine stops working? That's precisely where we are right now. Let me ask you something and be honest with yourself. If you had to guess what percentage of stocks today are owned by people who've been in the market less than 5 years, the answer might surprise you. It's more than 40%. 40% of the market is driven by people who have never seen a real downturn. They think a correction is when a stock drops 5% and bounces back in a week. That's not a correction. That's noise. And the reason that matters is because markets are made of people. And when the people change, the market psychology changes. Now combine that with something even more dangerous, leverage. People aren't just investing, they're borrowing to invest. Margin debt is near all-time highs. I've seen this before. In 1999, during the dot-com boom, in 2007 during the housing bubble, and every time the same words get used. This time is different. It never is. The illusion economy. But before I tell you what's coming, Let me show you why people can't see it, because that's what traps even smart investors. We've entered what I call the illusion economy. Everything looks fine on the surface, the unemployment rate, GDP, consumer spending. But underneath, many households are straining. Credit card debt is at record levels. Savings rates are at record lows. And everywhere you look on social media, financial news, YouTube, there's hype. Hype about gold going higher, about the next hot stock, about getting rich quick. And the crowd tends to buy at the wrong time, driven by emotion rather than fundamentals. When you combine these factors, central bank actions, geopolitical tension, retail speculation, you get rapid price rises. And rapid price rises fueled by emotion almost always reach a tipping point. That's what we're seeing now. The 2008 echo. Let me take you back to 2007. Markets were at all-time highs. The Dow was booming. Banks were reporting record profits. People thought the worst was over after a few hiccups in housing. And then, in September of 2008, everything froze. I remember that week vividly. Lehman collapsed. AIG was hours from bankruptcy. Credit vanished overnight. It wasn't just numbers on a screen, it was fear in the streets. Now, people say that can't happen again, and I agree. It won't happen the same way, but it can happen in a new way. And I'll explain what form it's taking right now. But first, let me pause and say something important. I'm not here to scare you. I'm here to prepare you. I've lived through 14 recessions. I've seen booms, busts, bubbles, panics, and every single time the same principles hold true. 1, the crowd is usually wrong at the extremes. 2, value doesn't disappear, it just hides. 3, discipline beats prediction. And that third one, discipline, that's what saves investors. Because when everyone is chasing momentum, the disciplined investor is quietly building wealth. The great wealth divergence. Now back to that secret about gold I promised to tell you. Here it is. We're approaching a moment when the total market value of productive assets, the businesses that create, innovate, and generate cash flow, will become so monumentally larger than the total value of all gold that the comparison will start to feel absurd. For decades, this gap has been growing quietly, but we've reached a point where the scale of it is becoming almost nonsensical. The wealth being generated every single year by productive businesses now dwarfs the entire value of all the gold in the world. And this is what's about to happen. It's not that gold will crash to zero. It's not that it will be worthless. It's that gold is becoming terminally irrelevant as a store of long-term value. The opportunity cost of owning gold is about to go vertical. Choosing to put your money in a sterile rock instead of a share of the global productive engine is becoming one of the worst financial decisions a person can make. It's like choosing to ride a donkey in the age of the jet engine. Sure, the donkey moves, but you're being left behind at a speed that's hard to comprehend. Think about it this way. The S&P 500 has an earnings yield that's the total earnings divided by the price. Right now, it's around 4 or 5%. That means for every dollar you invest, American businesses are earning 4 or 5 cents for you. That money can be paid out to you as dividends or reinvested to grow the business even more. What's the earnings yield of gold? It's not zero, it's negative. You have to pay to store it. You have to pay to insure it. It actively costs you money to hold it. So the divergence is this. The world's productive engine is compounding positively. growing your wealth. Gold is compounding negatively, costing you money, and every single day that gap gets wider. The event, the thing that's about to happen, is a moment the market wakes up to this mathematical reality on a mass scale. Right now, people are still operating under the old paradigm, the old fear-based model. But technology and the flow of information are making the truth of this divergence more and more apparent. Younger investors aren't tied to the old dogmas. They look at a company like Apple that generates over $100 billion a year in free cash flow, and they compare it to a lump of metal, and the choice is obvious. The final catalyst will come when large pools of capital, pension funds, sovereign wealth funds, start to publicly question the logic of holding gold. When their analysts present them with the brutal math of the opportunity cost, they will begin to slowly and then quickly reallocate. They will trade their sterile asset for a productive one, and that will be the final nail. Not because it will cause a price crash, but because it will be the final recognition that gold has lost its place in the modern portfolio. The AI mania. Now, let me talk about something that's going to define the next decade of investing: artificial intelligence. AI is the new .com. Everyone's chasing it. Everyone's afraid of missing out. But most AI companies will disappear, just like most internet startups did in 2000. That doesn't mean the technology is worthless. It means the mania around it is. The winners will be few but monumental. The losers will be many but loud. So when you look at AI, ask yourself, does this company make money from AI, or does it just talk about AI? That's the test. And I'll tell you, 90% just talk. I'll make a prediction. 10 years from now, the world will look back at this era, 2024 to 2025, and realize it wasn't the age of innovation. It was the age of exaggeration. Too much noise, too little substance. That's why patience is now a competitive advantage. If you can sit still while others chase, you'll win. If you can wait while others panic, you'll win bigger. Because wealth isn't built in bull markets, it's revealed in bear markets. The next downturn will expose who was speculating and who was investing. Make sure you're in the second group, the confidence trap. Now, let me tell you what makes this market different from 2008. Back then, it was leverage and housing. Today, it's confidence and speed. Confidence is what keeps economies running. Once people lose faith in currencies, in institutions, in each other, the system shakes. And right now, confidence is fragile, more fragile than it looks. We've also got what I call the silent liquidity trap. For the last decade, money flowed freely. Venture capital, private equity, crypto, meme stocks, cash poured into anything that looked like the future. But now the cash is tightening. It's not that there's no money out there, it's that it's stuck, sitting in short-term instruments, waiting. Investors are afraid to commit long-term because they don't trust the signals anymore. You can feel it, a kind of hesitation in the market's heartbeat. And when liquidity hesitates, risk starts building in corners nobody is looking at. It's exactly what happened before the financial crisis. What history teaches us. Let me share something personal. In 2008, I got thousands of letters from ordinary people, retirees, teachers, small business owners, terrified they'd lose everything. Some of them did, temporarily. But the ones who stayed disciplined, the ones who held on to solid businesses, they recovered. They didn't just survive the crash, they came out stronger. That's the paradox of a crisis. It rewards conviction. And conviction comes from understanding, not from guessing. So what does that mean for you sitting here today? It means stop outsourcing your thinking. Don't let social media or gurus or even me make your decisions for you. Use your own judgment. Build your patience. If a stock needs constant excitement to stay up, it's not a business, it's a bet. And you can't build a life on bets. You build it on principles. The delusion of momentum. Right now we're in a cycle that's been stretched longer than any other in history. 15 years of low rates, easy money, and a belief that crashes are old-fashioned. That belief is dangerous because markets don't care what you believe, they care what's real. And reality always wins, eventually. I've watched cycles like this before. In the late 90s, people thought the internet changed all the rules. Earnings don't matter, they said. It's about eyeballs and clicks. Different words, same delusion. And delusion is the root of every bubble. When people stop asking what is it worth and start asking what's next, that's when I get cautious. And right now, too many people are asking what's next. Every dollar is a vote. Let me take you back to a simple truth. Every dollar you invest is a vote for the kind of future you believe in. If you invest in hype, you're voting for chaos. If you invest in value, you're voting for endurance. So cast your votes carefully. And if you're not sure where to vote, start small, start slow, but start smart. What you can do today. Now, I said earlier I'd share what ordinary investors can do today to prepare. So let me make this very practical. Here's what I'd do if I were managing a modest portfolio right now. 1. Hold 20 to 30% in cash or its equivalent. You'll sleep better and you'll have dry powder when prices fall. 2. Stick to businesses you'd be comfortable owning if the stock market closed for 10 years. Think energy, infrastructure, consumer essentials, strong banks. 3. Eliminate leverage. If you owe money on margin, get out. The interest you save is a guaranteed profit. Investing isn't about predicting the crash. It's about insulation, not indulgence. It's not about having more toys. It's about having more time. And time is the one thing no market cycle can take from you unless you trade it away for noise. My 3-step plan. Now, everyone wants predictions. They want the magic date, the headline, the number that tells them when the music stops. But the truth is simpler and in a way more serious. What matters most isn't the timing of the next crash, it's the structure that creates it. And right now that structure is more fragile than it looks. So here's my 3-step plan to not only survive this divergence, but to position yourself on the right side of it. Step 1, acknowledge your fear, but separate it from your investing strategy. It's okay to be worried about the future, about inflation, about government debt. These are legitimate concerns, but you cannot let that fear drive you into a sterile asset. So do this. Take out a piece of paper and write down your financial fears. I'm afraid of my savings losing value. I'm afraid of a market crash. Get it all out. Looking at those fears written down separates the emotion from the action. Because your goal isn't to find an asset that makes you feel less scared today. Your goal is to own assets that will build your wealth over the next 10, 20, 30 years, regardless of the headlines. Step 2. Buy the engine, don't buy the anchor. The single best thing most people can do, and I've been saying this for 50 years, and it's more true today than ever, is to consistently buy a low-cost S&P 500 index fund. Let me break down why. When you do this, you're not betting on a single company. You're not trying to pick winners. You're buying a slice of the 500 largest, most productive, most innovative companies in America. You become a part owner of Apple, Microsoft, Johnson & Johnson, Coca-Cola. You own a piece of the farm, not the rock. You're harnessing the greatest wealth creation machine in human history. And you don't need a lot of money to start. You can begin with $50 a month, $100 a month. The amount doesn't matter as much as the consistency. Step 3, automate it and ignore the noise. The biggest enemy of the individual investor isn't the market, it's themselves. They buy high when they're excited, they sell low when they're scared. So take yourself out of the equation. Set up an automatic investment every single month, the same amount, into your index fund, rain or shine. When the market's up, you'll buy fewer shares. When the market's down and everyone is panicking, that same automatic investment will buy more shares. You'll automatically be buying low. This simple strategy, dollar cost averaging into a broad index of productive American businesses, is the most reliable path to wealth for the vast majority of people. It requires no genius, no special insight, no perfect timing. It only requires discipline and the faith that the American economic engine over the long term will continue to produce. And that has been the single best bet you could have made for the last 100 years. The solution isn't to run. Let me repeat this because it's the core of everything we've talked about. The solution is not to run from fear and hide your money in a sterile asset. The solution is to harness the collective genius and productivity of the greatest businesses in the world. Buy a piece of them consistently and let the power of compounding work its magic for you. The great secret. So here's the great secret of the gold market. The gold market is a distraction. It's a sideshow. It's a story based on ancient fears, not modern realities. The real story, the place where fortunes will be made, is in owning the things that create, that produce, that innovate. The coming divergence will make this clearer than ever. Those who own the sterile cube will see their purchasing power stagnate. Those who own a slice of the productive farm will see their wealth grow and compound in ways that can secure their family's future. Don't let the fearmongers trick you into making a multi-decade mistake. Don't trade the dynamic, wealth-creating engine of American business for a shiny rock that just sits there. The choice seems pretty simple when you lay it out like that, doesn't it? The coming awakening. Now, I want to be clear about something. I'm not predicting a specific date for a crash. I don't know when it will happen. Nobody does. But I do know this. The 3 signals I've been watching, excessive leverage, shrinking liquidity, and mass overconfidence, are all flashing warning signs right now. History doesn't repeat exactly, but it rhymes. And right now, I'm hearing verses I've heard before. The crash, when it comes, won't announce itself. It will feel sudden, even though it's been building for years. And the people who survive it, who thrive through it, they'll be the ones who prepared, not by predicting the timing, but by understanding the structure. A personal note. You know, I'm sada the najdivebroblis. I'm eating a lot. And very mentures all long I've center-locked and camptisnally, and fear makes you do the wrong thing at the wrong time. It makes you sell low. It makes you hide in gold when you should be buying businesses. It makes you trade your precious time for noise. Don't make that mistake, because time is the one asset you can never get back. The great event. So, the great event isn't a crash date on a calendar. It's an awakening to a mathematical truth that's been building for decades. It's the realization that productive assets, businesses that create value, employ people, and serve customers, are the only reliable path to long-term wealth. And for you, watching this today, that awakening can start right now. You don't need to wait for a crash to prepare for it. You don't need to know the exact date to understand the structure. You don't need to be rich to start building wealth. You just need to understand one simple truth. Wealth is built by owning productive assets consistently over time, not by chasing fear, not by hiding in metal, not by timing the market, just by staying in the game with the right assets for the long haul. Final thoughts. Listen, I know this has been a lot. We've covered gold, crashes, AI, fear, discipline, and the very nature of wealth itself. But if you take away just one thing from our time together, let it be this. The future belongs to those who own productive assets. Period. Not speculation. Not the hot tip you saw online. Just simple, boring, productive businesses that make things, sell things, serve people, and generate cash flow year after year after year. That's how you build wealth. That's how you protect your family. That's how you sleep at night. Everything else is noise. So tune out the noise. Acknowledge your fears, but don't let them rule you. Buy a piece of the productive engine of America. Automate it. And then go live your life. Because at the end of the day, wealth isn't about having the most money. It's about having the most time. Time with your family. Time to do what you love. Time to make a difference. And the investors who understand that, who build their portfolios with time in mind, not fear, they're the ones who win. The great event is already happening. The divergence is already underway. The question isn't when it will arrive. The question is, which side will you be on when it does? Choose wisely. And remember, the best time to plant a tree was 20 years ago. The second best time is today. Thank you for your time. Now go out there and make good decisions. And if you're feeling scared about the future, well, that's okay. Just don't let that fear trick you into giving up on tomorrow, because tomorrow always comes. And the prepared investor? Well, they're the ones who get to enjoy it.